Greetings everyone and welcome to Persian Money channel where we help people with their finances. My name is Arash Shahriari, an IRS enrolled agent as well as a health and life insurance agent. And in this video, I'm going to talk about how to do 1040 NR or 1040 non-resident form. This video is going to be part of the series of videos that I'm going to do about the taxes and offer you a wealth of information for doing your taxes. So without further ado, let's get into that. In the first part of the video, we're going to go over a series of slides and explain the concepts that you need to know and understand to do the 1040 NR. And in the second part, we're going to do an actual practice form so you can better capture the whole thing. So before we get started, we have to establish if to begin with you're considered a resident or a non-resident. In order to do that, we're going to look at scenarios that potentially will make the person a tax resident in the United States. The first thing to understand is that tax residence is not the same as immigration residency status. So just because you have an immigration status in the United States, that doesn't make you a tax resident. These are two completely different matters. So there are three tests that can potentially determine somebody as a resident in the United States. The first one is a citizenship test. You're always a U.S. tax resident so long you're a U.S. citizen, irrespective of where in the world you live. So no matter where you live, if you're a U.S. citizen, whether born or naturalized, you're always considered a tax resident for tax purposes. The second test is the green card test. You're considered U.S. tax resident if you had a green card upon arrival in the U.S. Date of residency starts from the date of arrival, and therefore pre-date of arrival international incomes do not count. So if any time during the tax year, and by the tax year we mean the year that you're filing for, you were granted a lawful permanent residency, you're considered a tax resident for tax purposes. As you may know, when you're a resident, you have to declare your international sources of income. It's not just limited to U.S. sources of income. However, for the first year upon your entry, prior to date of your arrival in U.S., if you had international income, you don't have to report those and declare them on your tax return. So now, speaking of this whole green card test, there are scenarios that you could lose your basically tax residency test if you have a green card. And there are only three scenarios, and this is important to mention because there's a lot of confusion over this matter. A lot of people think that just because they stayed outside the US for more than a year, or they don't live in America at all anymore, they're not subject to tax residency and filing requirements that applies to it. So there's only three scenarios that you end up losing your green card and your lawful permanent residency. Number one, you voluntarily renounce and abandon this status in writing to the USCIS. If you start writing to the USCIS and turning your green card, that's one scenario that you will lose your green card and your tax residency. The other scenario is that your immigrant status is administratively terminated by the USCIS, or number three, your immigrant status is judicially terminated by U.S. federal court. So these are the only three scenarios that no more you're considered lawful permanent resident and you don't have to file as a tax resident in the United States. There's a third test that we're going to look at, and that's called substantial presence test using number of days in US. And there's two ways to figure that out. The first one is if you're physically present in the United States on at least 183 days during the tax year. So if you happen to be in the United States for 183 days, that will make you a tax resident. If that's not the case, there's another subsection of this substantial present test, which falls into 4 segments. Number 1, you had to have stayed in US for at least 31 days during the tax year. If that pre-default is satisfied, then what you're going to do is to count all the days in the tax year that you were present, then go ahead and count all the days that you were present in the first year before the current tax year and divide those numbers by 3. And then go ahead and count all the days in the second year prior to the current tax year and divide that number by 6. At the end, you're going to add up all these numbers together. If sum of all these numbers together is going to exceed 183 days, then you're considered a tax resident. If not, then you're considered a non-resident. So here's an example just to clarify the substantial presence test. Let's say you were physically present in the US on 120 days in each of the years of 2021, 2022, and 2023. To determine if you meet the substantial presence test for 2023, you will count the full 120 days of presence in 2023, 40 days in 2022, which is 1/3 of the 120, and 20 days in 2021, which is 1/6 of the 120 days that you were present in 2021. So if you add these numbers up together, it would arrive at 180. Now, since 180 is still 3 days short of the 183 days, you're considered a non-resident for tax purposes. Now, here's where things potentially gets complicated. But I'm going to cover them as well. So even though under the substantial present test you may be qualified as a tax resident, there are still exemptions that it would still make you a non-resident, and we're going to go over them. So number 1, if you're foreign government individual under A or G visas, with the exception of the A3 and G5 visas. The second one is if you're a teacher or a trainee under a J or Q visa who substantially complies with the requirement of the visa for the first 2 years. Now, this basically definition, substantially complying with the requirements of the visa, is very detrimental. We're going to look at that later, because if you didn't on your part or the part of your academic institution, terms of that visa was not substantially complied with, then you exit this exemption that is granted to you for non-residency, and you become a tax resident. Number 3 is the students under F, J, M, or Q visas who substantially complies with the requirements of the visa for the first 5 years. Same thing applies here as well for that phrase of substantially complying with the requirements of the visa. Number 4 are the professional athletes temporarily in the United States to compete in a charitable sport event. So if you happen to be a professional athlete in US for just doing a charitable sport event, that's something that also will exempt you from tax residency. Now, even though you may been in US under the substantial present test more than 183 days, if you can establish closer connection to the foreign country that you're from or residents of, you could still exempt yourself from tax residency. The other scenario is that if you're a crew member on a transport vessel who don't engage in a trade or business. So if you happen to just be on a transport vessel, or you're basically like a air hostess, and you simply visit United States for the work matter of just transportation, then you're not considered a resident even if you satisfy the substantial present test. Now, this is the part that, speaking of that phrase, complying with the visa, things will also take a turn and potentially will make you an exception to the exemption of the substantial present test that we just went over. So let's say you're a teacher on a J or F visa and your wages was not paid to you, or they were not paid on time to you. This is a scenario that will exit you from the non-resident status that you were granted. Or let's say you're a student on F1 visa and you had a gap in your immigration status, or happen to hold a job outside the campus for the first year that you were not allowed to do so, or you exceeded the number of the hours of employment that you were allowed. These are also scenarios that will exit you from that non-residency exemption. If you happen to have a change of status of your visa to an immigrant status visa, after which the substantial, if you count the number of days and apply the substantial present test, you could be considered a tax resident. Now, speaking of that, simply applying for change of status doesn't change your non-residency, but once you're granted or approved for that immigration, immigrant visa, that's when things will take a turn and you could be potentially counted as the resident. Obviously, if you are granted a green card, you're automatically under the green card test considered a resident, irrespective of number of days that you were present after you got your green card. Now, the other scenario is that if you're a non-resident who is married to a U.S. tax resident, in this case, the spouses can elect to treat the non-resident spouse as a resident under section 6013G of the IRC code. So essentially what happens is that the spouse was a tax resident under this IRC section can elect to file married joint with their non-resident status and take advantage of the some of the perks that come along with the filing as a resident and married filing joint with their non-resident spouse. Now, keep in mind that if you go ahead this route, you have to report your foreign income for the non-resident spouse as well. The only exception would be that the non-resident spouse would not be subject to employment tax on their basically earned income from foreign sources. So now, once we establish whether we are considered a resident or not for the tax purposes, we want to just go ahead and try to understand what is the difference between a non-tax resident and a tax resident anyways. The first one has to do with the way that these two are taxed. The tax rate is different. So for the non-resident, depending on their source of income and type of income that they have, they could be taxed anywhere from 10 to 30%. Also, non-residents are taxed only under U.S. sources of income, whereas the residents are taxed under global sources of income. Non-residents also cannot claim dependents. So if you happen to have a child that lives with you under the as a derivative of your F1 visa, for instance, you cannot claim them in your taxes. The only exception is that if you as a taxpayer happen to be the residents of Canada, Mexico, South Korea, or India who was a student or business apprentice in the United States. The other difference is that non-residents are not allowed to take standard deduction. So in case you may not know, when you are a tax resident, you can deduct a set amount, which is called standard deduction, against your income and not make that subject to taxation. So non-residents are not allowed to take this standard deduction. Also, non-residents cannot file as married filing jointly the only option that is available if you're a married non-resident is to file married filing separately. The other difference is that non-residents cannot take on deductions, credits, such as the education credit or dependent credits. The only exception for claiming dependent is that if the dependent that you want to claim happens to be a citizen, national, or resident of the United States, or resident of Canada or Mexico, and also you have to yourself be also a resident of Canada, Mexico, South Korea, or India. So both these criteria have to be satisfied in order for you to be able to claim a dependent on your tax and take advantage of the child tax credit that potentially comes with it. Now, here we're going to look at the two different types of the income that are treated differently for tax purposes as a non-resident. So the first one is called FDAP, which stands for Fixed Determinable Annual or Periodical Income. So by definition, FDAP is all incomes except gains derived from the sale of real or personal property, including market discount and option premiums, but not including original issue discounts, as well as the items of income excluded from gross income without regard to the U.S. or foreign status of the owner of the income, such as tax-exempt municipal bond interest and qualified scholarship income. So this is the legal definition of it, but essentially FDAP income consists primarily of passive investment income, such as interest, dividends, rents, royalties. Now, for those you might not know, passive income is essentially type of income that is not earned, meaning that you were not actively working towards it, such as, if you're employed on a job or you happen to run a self-employment business and you're actively materially contributing to earning that money. So if you're like renting a place, that property that you renting is just sitting by itself. You don't have to perform any work to make that income. Thus far, it's called passive income. So rents, interest, dividends that, for example, you derive from investing in a company, or interest that you collect, for simply depositing money in a saving account or money market account. These are considered passive income and fall under the FDAP. Now, the characteristics of the FDAP is that deductions are not allowed against this FDAP income. You cannot make any deductions. Say, for example, if you're rental income, you cannot make a deduction against the income that you earned. And they're taxed at a flat rate of 30% or lesser under tax treaty provision. So there's a flat tax rate of 30% that is applied to the FDAP unless you happen to be from a country that has a tax treaty with the United States and offers you a lower tax rate on that FDAP income. FDAP income is reported on a Schedule NEC of Form 1040 and R. That's where you report the income. The other type, and basically the other type, is ECI, or effectively connected income. ECI income, by definition, relates to an activity such as a trade or business under the principles of U.S. tax law, including the personal service income of an individual who performs services in the United States. So, types of the investments income that will be considered ECI, even though by definition under prior type that we speak of, there might be considered FDAP, is that if the income is associated with a U.S. asset used in or held for use in the conduct of that trade or business. So even if you hold an asset for investment, but you use that asset to make a a trade or business, that income also falls under the ECI. Or if the activities of that trade or business conducted in the US are material factors in the realization of that income. So in the same manner, if you use the proceeds of that passive income is used and is materially important to you be able to make that income from the trade or business, this is also another way that it basically changes the definition of the FDAP to the ECI. Now, the characteristics of the ECI is that deductions are allowed, and ECI is taxed at the same graduated rates used by tax residents. The income from ECI is reported in various forms similar to those used for tax residents. Now, in the next part, we're going to look at the types of deduction from income that you can use against your income to reduce your tax liability. So these deductions are elected and declared on Schedule E of Form 1040-NR. So there are 4 general types of deductions that you can go about. The first one is the states and local income taxes paid. Now, these taxes that you're going to claim should not exceed $10,000, or if you're filing as married, filing separately, shouldn't exceed $5,000. Number 2 is gifts to U.S. charities by cash, check, non-cash, or carryable from previous year, limited to 50% of the AGI. So you're allowed to basically make a deduction for amounts that you gave to the charities, so long that it can be substantiated either by appraisal, by receipt that you receive from the charity, and there's a whole list of the basically what are considered charitable deduction and donations in publication 526 that you can refer to, but they cannot exceed the 50% of your adjusted gross income, and that number AGI is on line 11 of the Form 1040-NR. There's also an exception to the definition that allows you to deduct charitable gifts, and that is if you donate it to a Canadian, Mexican, or Israeli charity. So if you happen to donate to any of these 3 countries' charities, you can still go ahead and make a deduction on that. The third one is casualty and theft losses from federally declared disaster. So if you happen to be living in an area that was declared by federal government as a disaster area, you can go ahead and fill out the form 4684 and calculate the amount of loss that you had, and then you can also import that to Schedule A and deduct it against your expenses. The fourth one are basically a variety of deductions as miscellaneous that you can go about. Number 1 is gambling losses effectively connected with a U.S. trade or business, only to the extent of gambling winnings reported on Schedule 1 of 1040-NR line 8B. So if you happen to have losses from gambling and you want to deduct them, you can go ahead and do that. Just keep in mind that you're limited to the amount of your winnings. You cannot claim a loss in excess of the winnings that you had. The second one is casualty and theft loss of income producing property from Form 4684 lines 32 and 38B, or Form 4797 line 18A. So if you were running a trade or business and you had a income producing property, equipment that you were using, for example, and you had a casualty or loss or theft on that equipment, you can go ahead and fill out the Form 4684 or Form 4797 and import the results to Schedule A. The next one are the deduction for repayments of amount under a claim of right if over $33,000. So say if you were disbursed an income, basically you earn a wages that was by mistake, and you were required to pay them back, and they were in excess of $3,000. You can go ahead and deduct the amount that you had to repay in excess of that $3,000 on your Schedule A. You can also refer to publication 525 for further details. Certain unrecovered investments in a pension. So if you happen to have losses, specific losses on the investment that you were having in your pension account, you can also deduct them as well. The last category are impairment related work expenses if you happen to be a disabled person. So if you're a disabled person and to fulfill your job you need to use certain equipment or items, you can go ahead and claim them. If you use a wheelchair, for example, if you work, if you need to wear diapers, or you need to wear certain shoes, or for example diabetes straps that you need to wear. These are examples of impairment related work expenses that you can also deduct. As part of doing the non-resident 1040-NR tax return, there's also a schedule called Schedule OI, other information that you also need to fill out, and there are various questions on that form that you need to answer. So 12 of those, which are the majority of them, I haven't addressed here. The first one asks you the country of nationality, country of citizenship, whether you have ever applied for a green card, or if you ever had a green card at all, whether you have been a US citizen before, type of visa on the last day of the tax year, whether you have ever changed your visa type, listing the dates of entering or leaving US, as well as the dates you commuted as a Canadian or a Mexican resident to US. Number 8, number of days present in US, including days on vacation, non-working days, and partial days. Whether you filed tax return previously and the year that you filed the tax return. Whether you received compensation in excess of $250,000. If you're claiming a tax treaty provision against your income, you can go ahead and include that tax treaty provision in this segment. So, election to treat real property income as effectively connected income. So this number 12, I'm going to go over it and give you an explanation. So essentially, if you're a non-resident in US, but you do have a rental property, for example, that you are making money from, under the FDAP, that property income would be considered basically taxable as 30% flat without being able to make any deductions. However, the IRC code does allow you to go ahead and make the election to treat that income as effectively connected income, and that will allow you to make the deductions from that and also reduce the tax rate that is applied to that income. Now, there is something to keep in mind about this. Once you do make this election, if you happen to not be present in the US at all, or basically at any calendar year, since you had this real property, you were not in US in excess of the 183 days, what's going to happen is that you're still going to pay a capital gain tax once you're going to sell that property. So this is something that's going to happen. Basically, it's a trade-off. If you keep the property under the FDAP and not make this election, if you never been in US or very few days, less than the 183 days in any given calendar year, once you do sell your property, you're not subject to the capital gain. So it's a trade-off that you're making, and you have to determine which route you want to take. Also, speaking of that, if you're here in US on one of those exemptions visa like F, J, Q, or A visas, that exemption doesn't apply, meaning that whether you make the effectively connected income election or not, you still would pay the capital gain tax on your property when you're selling it. So the next form that you have to fill out as part of your taxes as a non-resident is Form 8843, Statement for Exempt Individuals and Individuals with Medical Conditions. Essentially, the purpose of this form is to substantiate why you're claiming the exemption from residency for tax purposes. This is what IRS wants you to fill out to show them that, and show them the evidence and the information that they need in order, if they were to substantiate your claim that you're exempt from residency for tax purposes. Part 1 of this form has to do with general information, and the subsequent sections is specific to type of the basically position that you held throughout the tax year. So general information involved the type of visa and the date you enter US, current non-immigrant status, countries of citizenship, number of days present in US during the last 3 years. The part 2 is specific to teachers and trainees. So for teachers, they need to put down the name, address, and phone number of the academic institution. For trainees, they need to put down the name, address, and phone number of the director of the academic program that they were in. Type of visa they had in the year, whether they were exempt from resident status for any part of the 2 years of the preceding 6 years. Part 3 is specific to students, and you need to put down the set of information in this section: name, address, and phone number of the academic institution they attended, name, address, and phone number of the director of the academic program they participated, type of visa held during the tax year, whether they were exempt as teacher, trainee, or student from resident status for any part of the 5 calendar years, whether they took affirmative actions to apply or have a pending application for lawful permanent residency. So regarding this part, just kind of reiterate, now applying per se or having a pending application for green card or also known as lawful permanent resident doesn't change your non-resident exemption. However, it's a question that they want you to know and give an explanation if that's something that you've done. But then again, once you finally do get approved in the year that you're filing taxes, you will be considered a tax resident nonetheless. The next session is specific to the professional athletes. So if you are here in US to participate in charitable sport events, you're going to put down the name of charitable sport event you attended, the name and employer identification number, also known as EIN, of charitable organizations. The last part is specific to individuals with medical conditions or medical problems. So if you were a non-immigrant in US and basically you wanted to leave US before that 183 day of substantial present test kicks in, but you were forbade to do so because of a medical condition or a medical problem that you had, you will go ahead and fill out this section. So in the first segment, it will ask you for a description of the problem or condition that prevented you from leaving US. And also, if you happen to be a student, for example, the name, address, and phone number of the academic institution you attended. The second segment will ask you about the date you intended to leave US prior to onset of the medical condition or medical problem that you faced. The third one asks you the date you actually left US. And the last segment will ask you to have a physician write a statement basically affirming your description of the medical condition or medical problem that you had, and they also need to sign that form, put their name and address in the form to substantiate your claim. So with that being said, we're going to move on to the example that we're going to be looking at that I've prepared so you can get a clear idea about how these actually apply in a real example. Alright, so here we have a fictitious student who is on F1 visa, and he held a job at a company, Washington Lighter. He had $13,000 worth of wages that he had earned. He had no income tax withheld from him, and he also had no Social Security and Medicare tax withheld from him because he's a non-resident on an F1 visa. But however, he did pay $840 to the state as a state income tax. So based on this information, we're going to go ahead and start doing his 1040-NR form. We're going to go ahead and put down his name, his Social Security number, his address. He's a married person, so we're going to select the filing status for married filing separately. He also has a dependent, and we're going to go ahead and include it. And since he himself is a Canadian resident and his child is also a Canadian resident, he qualifies for claiming his dependent, and he qualifies for the child tax credit. So we're going to go ahead and include his W-2 wages for $13,000 on line 1, and we're going to come down here to the point that we get to the itemized deduction that we draw from the Schedule A. So we're going to look at that, and we're going to come back to here to continue. So on the Schedule A, we're going to go ahead and enter the state and local income taxes that he paid in the amount of $840, and he had no charitable gifts that gave away or no other casualty losses, so his total comes down to $840. So this is the amount that we're going to import here and put down. His taxable income would be reduced to $12,160. On the second page, based on the income that he had, the tax that he has to pay is $1,241. So as I said, he qualifies for the child tax credit in the amount of $2,000. However, for the non-residents, the way that this would be actually figured out is slightly different. So based on his tax liability, the initial amount of $2,441, that is, up to the amount of his tax liability, would be applied here, which essentially would bring his tax liability to 0. And then on line 28, as you can see, the additional child tax credit from Schedule 8812 in the amount of $759 that he's entitled to would be transferred over here, which would give him a refund of $759. So this is the part of his 1040 return. We already went over the Schedule A. Now we're going to look at the Schedule OI. He's a Canadian resident, so we're going to put down the information for his citizenship and his country of residence. He never applied for a green card. He's not a U.S. citizen. He never been a U.S. citizen. He never had a change in his visa. On line E, we're going to put down the type of the visa that he held. He was present in the U.S. the entire 365 days. He never made any commute or he never left U.S. The next segment is that if he filed a tax return in the previous year, we're going to answer yes. We're going to put down what kind of a form and what year he filled out the form. So we're going to move on. He didn't receive a compensation in excess of $250,000. And also he's not claiming any tax treaty. So we're just going to leave that blank. This is schedule 8812, where you would be going to calculate how much child tax credit you're entitled to. I'm going to pass on this form because it's just a few numbers that basically need to be plugged in, and if you're using a tax software, typically it will do it automatically for you based on the date of birth of the child. Essentially what you need to know is that to qualify for the child tax credit, there are 3 criteria that has to be met. One of them is that the child has to be under the age of the 17 before the end of the tax year. They must have a social security number, and your income yourself shouldn't exceed $200,000. So if your income is above this amount, you would not qualify for the child tax credit. These are some of the criteria, it's not the whole thing. That would be for another video to go over the child tax credit. This is the second page of form 8812, which essentially determines how much he is qualified as for the additional child tax credit. This is form 8843 that we spoke of, and here's where we're going to substantiate why he qualifies as the non-tax resident. Part 1, the information from form 1040NR fulfills that. We don't need to enter any additional information. However, if you're manually doing that, you can go ahead and fill them out. It's very basic information. It asks you for type of the visa, in this case F1, country of the citizenship, passport number, and the country that you held the passport from. In the case of this particular client, he's a student, so part 3 is a segment that he has to go ahead and fill out. He's going to, on the line 9, he's going to put the name, address, and telephone number of the academic institution he attended in 2023. We put down the name of the school, John Washington University, the address of the university. In the second part, line 10, he's going to enter the name, address, and phone number of the director of the academic or the special program he participated during the tax year. We're going to put the name of the director here. It was John Washington, the address of him in the university, and his phone number. Line 11, we're going to put down the type of the visa that he was on. Line 12 is going to ask if you were exempt as a teacher, trainee, or student for any part of more than 5 calendar years. The answer is no. He still hasn't been in US for 5 years. Question 13 is going to ask is that if he ever applied, take other affirmative steps to apply for lawful permanent residency in US, or have an application pending to change his status to lawful present. He never applied for that, so we're going to put that no. And as I said, the rest do not apply to him unless you have a particular scenario, like if you happen to have an individual with a medical condition or medical problem. So with that being said, it concludes the video. I hope you enjoyed this video. I'm an IRS enrolled agent. If you want to work with me or have any question, you can reach out to me. My contact information is in the description. Until the next video, see you.
Okay.